Hello and welcome to an FX Times daily video recap. I'm CMS Forex market analyst Nick Nassad. Today's Monday, December 28th, 2009. Today's market faced rather thin liquidity conditions, which is typical for the days between the Christmas and New Year's break. And we even had holidays in the UK and Canada where banks and their equity markets were closed, which only increased how thin liquidity was today. There was a bit of risk appetite overnight, which was bolstered by data out of China, showing profits at industrial companies rising 7.8% in the 11 months through November from the same period a year earlier. That returned profits to pre-crisis levels and bolstered the case that China is in the midst of a strong rebound in its economy thanks to some record fiscal stimulus from the government as well as an expansion of credit. Now, the Chinese government is committed to a proactive fiscal stance and a moderately loose monetary policy, as well as a stable exchange rate, so growth should be supported by those measures. While there were no key U.S. releases today, we did have the Chicago Fed post its manufacturing index, which rose to 84.2 in November from 83.2 in October. That was a 1.2% jump in the index and moved it to its highest level this year. Activity picked up in all four industry sectors that make up the index. Finally, we had the Fed auction off $44 billion in 2-year notes, which saw decent interest in the bond market. That was mainly as a result of rising yields. While demand for this week's sale wasn't as stellar as it was in previous auctions, with the sale drawing about $128 billion in bonds, or 2.91 times the amount on offer. Given the holiday shortened week, and with many investors away from their desks ahead of the New Year holiday, the auction outcome was better than many had anticipated. Now let's bring up our main pair, the euro-dollar. As you can see here in today's trading, we stuck within the range we saw on Thursday's session. As we started testing our low here around 1.4350, rose to 1.44 around the open of New York trading, but then we were unable to move above our resistance from last week, and in late New York trading we saw the euro give up a good portion of its earlier gains. That returned the pair to what we have here is a 50-period moving average. We're using 1-hour candles. And now we're testing that level prior to the Asian session. Zooming this pair out, we do see that the euro-dollar pair, following its very sharp slide in December, all the way from around 1.51 down to 1.42, has seen a little bit of a move in favor of the euro the last couple of sessions. So we did find some support, and now it seems that we have a bit of consolidation going on. We saw a bit of a similar dynamic in the pound-dollar pair. As you can see here, we had slid in favor of the greenback in late December, but then we have found support recently at the 1.5930 level. We see that this support held in the middle of last week, and we closed around that level, but today, following a test of that in our open, we rallied again, similar to the euro dollar, to try and test Thursday's high. So we could draw another trend line and can say that perhaps we're setting up in a bit of a consolidation sideways action to start the week. The dollar-yen pair, meanwhile, held near its highs from last week, around the 91.80 level. And here trading was extremely flat in our thin liquidity conditions. So not much to say about the dollar-yen pair. One pair that did see a move out of its established range from last week was the US dollar-Canadian dollar pair. Here we see that in today's trading we slid in favor of the Canadian dollar, falling below the 1.0450 level. Let's draw a horizontal line here. And this move came just after the New York Open, with the break coming around 11 a.m. Eastern. Earlier in the session, we had tested our moving average, our 50-period moving average, and that did act as resistance, as well as our high from Thursday's session around 1.05. Zooming this pair out, we see that we did break this upward sloping line of support in early last week, and we have extended the gains for the Loonie since then. We now come close to our 1.04 level, which acted as support throughout most of November and December. So we'll see if we are going to test that area in this week's trading. And well, we're obviously going to have to monitor what happens and how traders behave once we do test that area. We can see though that after the pair tested the 1.0750 level 2 weeks ago, which was an important resistance, we have slid back down now to our support. So if we look at this as more of a consolidation sideways range, we're now approaching the support level of that range. The Canadian dollar was bolstered by risk appetite at the beginning of US trading, as we had higher oil prices and we had higher equities. Here we're looking at the US. As you can see, the Dow, Nasdaq, and S&P all finished higher than where they started, though we did see a move into negative territory for here the Dow Jones Index around 2 p.m., between 2 and 3 p.m., though there was a rally late to finish higher. The fundamental docket remains rather light in tomorrow's session. Overnight, we get data from Switzerland. It's UBS Consumption Indicator, a measure of consumer spending. We also get Germany's preliminary CPI for the month of December, which is expected to show a 0.6% increase on the month, following a 0.1% decline in November. Also, we get UK housing equity withdrawal figures for the third quarter. Tomorrow we get two releases from the US, the S&P Case-Shiller 20 City House Price Index and the Conference Board Measure of Consumer Confidence. The House Price Index is expected to show annual house price declines continuing to ease, while the Consumer Confidence Index for the month of December is expected to rise from its 49.5 in November to a reading of 53.0. And that wraps up what was a rather quiet day in the Forex markets. I want to thank you for watching today's daily video recap. To see more news, video, and analysis, please visit our site fxtimes.com. Thank you once again, and happy trading.